If you're a father, husband, grandfather, or the man your family depends on, insurance is not just about having a policy. It is about protecting the people who count on you. We know and understand fatherhood brings responsibility. You may be paying the mortgage, raising children, supporting a spouse, caring for aging parents, or simply preparing for retirement. The right protection plan can help make sure that one unexpected event does not place your family in a financial crisis. See, many fathers work hard to provide for their families, but sometimes they do not stop long enough to ask an important question. If something happened to me, would my family still be financially okay? That question is not meant to scare anyone. It is meant to help you think clearly. Your family's financial plan should not depend only on hope. It should include practical protection, savings, retirement planning, and a strategy for the future. Today, I want to talk about the basic areas fathers should think about: life insurance, disability insurance, long-term care planning, investment planning, and retirement planning. So let's get started. The first area fathers should consider is life insurance. Life insurance is designed to provide money to your loved ones if you pass away. For a father, that money may help replace income, pay off debt, cover final expenses, or provide time for your spouse or family to adjust financially. But fathers should also understand this: life insurance may not only be for when you die. Some policies include living benefits, which may allow you to access part of the death benefit while you are still living. If you experience a qualifying serious, chronic, critical, or terminal illness, that means life insurance may help your family while you are alive, not just after you are gone. For example, if a father has a covered serious illness and cannot work the same way, living benefits may help with medical bills, household expenses, recovery costs, or other financial needs. The exact benefit depends on the policy, the rider, and the insurance company's rules, so it is important to review the details carefully. Here's an eye-opening statistic. There's a report found that about 100 million Americans say they need life insurance or more life insurance coverage. That is a large protection gap. The key issue is not just whether you have life insurance. The key issue is whether you have the right amount of life insurance and the right type for your situation. Some people have a small policy through work and assume they are covered. And yeah, it is helpful, but it may not be enough. A workplace policy may only be 1 or 2 times your salary. If you have a mortgage, children, debts, or years of income that your family depends on, that amount may fall way short. There are different types of life insurance. Term life insurance provides coverage for a specific period of time, such as 10, 20, or 30 years. It is often used to protect the years when your family depends on your income the most and the most cost efficient. As for permanent or whole life insurance, it's designed to last longer, as long as policy requirements are met, of course. See, the kicker is, permanent or whole policies build cash value over time. Now, that does not mean permanent or whole life insurance is right for everyone, but it may be worth reviewing depending on your goals, budget, and long-term needs. For fathers, life insurance should be connected to real responsibilities. Think about your mortgage, your children's ages, your spouse's income, and any debts that would remain if you were no longer here. And remember this: life insurance is not just about you passing away. It can also be used to protect your family while you are living. When you use the bank on yourself component to borrow from the cash value for any funding need. The next area is disability insurance. Many fathers understand the need for life insurance, but they may overlook disability insurance. Here is a question to consider. What happens if you do not pass away and you find yourself unable to work because of an illness or injury? This is one of the most difficult financial situations for a family. The income may stop or decrease, but the bills usually keep on coming. You find yourself in a situation where the mortgage still has to be paid, groceries still have to be bought, and the hits just keep on coming with utilities, childcare, car note, and other expenses that don't pause just because your paycheck did. See, disability insurance is designed to replace part of your income if you are unable to work due to a covered disability. This can help your family maintain stability while you recover or adjust. Here is an eye-opening statistic. The Social Security Administration has reported that more than 1 in 4 20-year-olds will become disabled before reaching normal retirement age. That means disability planning is not just for someone else. It is a real risk that working fathers should consider. So as a father, you may have disability coverage through work. That is a good place to start, but you still need to understand the details. How much of your income would it replace? Is it short-term, long-term, or both? How long will benefits last? Is the benefit taxable? What definition of disability does the policy use? These details matter because disability insurance is not just a policy. It is income protection. If your family depends on your paycheck, then protecting that paycheck should be part of your financial foundation. As we move along, another area fathers should think about is long-term care planning. Long-term care is often misunderstood. Many people assume it only applies to someone much older, but the planning should usually begin before there is a crisis. Long-term care means help with daily activities. That may include bathing, dressing, eating, mobility, or supervision due to cognitive issues. Care may happen at home, in an assisted living facility, or in a nursing home. Here is why this matters for fathers. A long-term care event can affect the whole family. It can place emotional, physical, and financial pressure on a spouse, adult children, or other loved ones. It can also impact retirement savings. Here's another eye-opening statistic. The U.S. Department of Health and Human Services has estimated that about 70% of people turning age 65 will need some type of long-term care services during their lifetime. That is an eye-opening number, especially for fathers who want to protect both their independence and their family's finances. Many people spend decades building retirement accounts, savings, and home equity. But if a long-term care need happens and there is no plan, those assets may have to be used quickly to pay for care. Long-term care planning is not only about buying insurance. It is about having a conversation. Who would help you? Where would you want to receive care? How would care be paid for? Would your spouse be financially secure if a large amount of savings had to be used for your care? These are not comfortable questions, but they are important ones. Planning early may give you more choices. Waiting until a health event happens can limit your options. This leads us to investment planning. This is definitely important for fathers to be concerned about for the long term. Now, investment planning is different from insurance, but they both can work together in a larger financial strategy. See, insurance helps protect against certain risks, but investments are used to grow money over time for future goals. For fathers, those goals may include retirement, college savings, building emergency savings, or creating long-term financial security. Let me share this statistic with you. The Federal Reserve Survey of Consumer Finances shows that many families have less saved for retirement than they may expect, especially when you consider how long retirement may last. And in this present economy, savings is not a luxury many people have. That is why investment planning should be intentional, not random. The important thing is to have a plan that matches your goals, time frame, risk tolerance, and family responsibilities. Investing is not about chasing the latest trend or trying to guess what the market will do next. It is about consistency, discipline, and understanding what you are investing for. A father in his 30s or 40s may be focused on raising children, paying a mortgage, building savings, and contributing to retirement accounts. However, a father in his 50s or 60s may be more focused on protecting what he has built, reducing unnecessary risks, catching up on retirement savings, and preparing for income in retirement. Those are different stages of life, and the investment approach may need to change as life changes. You should also understand how your investments are titled, who the beneficiaries are, and whether your accounts still match your current family situation. Marriage, divorce, children, blended families, job changes, and retirement can all create reasons to review your accounts. Investment planning should not be random. It should be tied to a purpose. Before investing, ask yourself, what is this money for? When will I need it? How much risk can I handle? What happens to my family if the market is down when I need the money? Those questions can help you make better decisions. This falls right in line with retirement planning, which is an area fathers shouldn't ignore. Many fathers spend years taking care of everyone else. They pay bills, support children, help family members, and handle responsibilities. But sometimes, while doing all of that, they put their own retirement planning on the back burner. The problem is, retirement does not become easier to plan for by waiting. And this statistic will bring it home. The Employee Benefit Research Institute has reported that many workers have not calculated how much money they will need in retirement. That means many people are saving without a clear target. A strong retirement plan should look at more than just how much money is in an account. It should consider future income, expenses, taxes, inflation, healthcare, long-term care risk, and how long the money may need to last. You may have a 401k IRA, pension, military retirement, Social Security, annuities, mutual funds, or other accounts. The question is not just whether you have these assets. The question is whether they are working together. For example, some fathers have several old retirement accounts from previous jobs. Those accounts may not be reviewed often. They may have outdated beneficiaries, investment choices that no longer fit, or fees that have been overlooked for years. Others may be getting close to retirement and still do not know how much monthly income they can reasonably expect. They may have saved money, but they do not yet have an income plan. That is an important difference. Saving for retirement is one phase, but creating retirement income is the phase that counts the most. When you retire, the paycheck may stop, but the need for income continues. You still need money for housing, food, transportation, healthcare, family needs, and emergencies. Retirement planning helps answer questions like, can I retire when I want to? How much income will I need? When should I consider taking Social Security? How will taxes affect my withdrawals? How much risk should I keep in my portfolio? What happens if I live longer than expected? What happens if the market drops early in retirement? These are very serious questions, and the answers are different for every family. But fathers should also think about their spouse or partner. If you are married, retirement planning should consider what happens if one spouse passes away first. Will the surviving spouse still have enough income? Will pension benefits change? Will Social Security income change? Will insurance coverage still be enough? A retirement plan should protect both people, not just the person who handled the finances. That leads us to another critical area fathers should think about, which is legacy planning. See, legacy planning is more than leaving money behind. It is about making sure your family has direction, protection, and clarity. If something happens to you, for fathers, this may include reviewing beneficiary designations on life insurance, retirement accounts, investment accounts, and other financial assets. A beneficiary form can sometimes control where money goes, so it is important to make sure those forms still match your current wishes. Legacy planning can also include making sure your life insurance is coordinated with your larger goals. The policy amount, ownership, beneficiaries, and purpose should all make sense for your family situation. And probably one of the most important things a father should do is to let family members know where important documents are located. That may include insurance policies, retirement account information, bank information, military and business records, and contact information for trusted professionals. This is also where estate planning conversations may come in. Keep in mind, I am not here to give legal advice, but fathers should speak with a qualified attorney about wills, powers of attorney, and healthcare directives. The goal is to make things easier for the people you love. A clear legacy plan can help reduce confusion, avoid unnecessary delays, and give your family a better path forward during a difficult time. A financial plan is stronger when insurance, investment, retirement, and legal pieces are coordinated. With those planning areas in mind, let's bring this back to the main question every father should ask. If something happened to me, will my family be financially okay? Then ask a second question. If I live a long life, am I preparing well for retirement and future care needs? Both questions matter. Life insurance helps protect your family if you pass away, and certain policies may also provide living benefits during a qualifying serious illness. Disability insurance helps protect your income if you cannot work. Long-term care planning helps protect your family and assets from the cost of care. Investment planning helps you build toward future goals. Retirement planning helps turn years of work and savings into a more secure future. The goal is not to buy every product available. The goal is to build a plan around your real life, your family, your responsibilities, and your future. Now, if this content was helpful, place a thumbs up in the comment section. This really helps with engagement and assists with pushing out this video to others. Also, word of mouth is good too. So please share this content with someone who may benefit from this topic. Then, check out my video library. I have information on home, auto, business, specialty insurance, and retirement. With all this being said, subscribe to my channel and help me get to 1,000 subscribers. But don't stop here. Check out my next video for more insurance and financial tips. And as I like to say, call Jay today.